Hi, everyone. I'm Rosemary Miller here with Gregory Warren, a senior stock analyst for Morningstar, here to give us an earnings reaction for Berkshire Hathaway. Thank you so much for joining me today, Greg.
Thanks for having me.
Absolutely. So, Greg, could you elaborate on Berkshire Hathaway's reported revenue growth in the fourth quarter and full year, and how much of it is attributed to specific acquisitions and operational changes?
Well, I think the biggest thing that happened last year was they absorbed the Allegheny deal, which closed in October of 2022. So the first 3 quarters of the year, you had a decent bump on the insurance side from that acquisition because it boosted earned premiums overall. So part of that growth that was there, I think the reinsurance and the primary groups both had earned premium growth in excess of 20% last year. But if you strip out the Allegheny purchase, it's probably mid-high single digit, which is about where it should have been because we still have a hardening market on the insurance side overall. So that was a good addition for them last year, was having that in the mix. You had your decent pricing overall. We had fewer catastrophes during the course of the year. So the insurance operations probably put up their best year we've seen from them ever, on that basis. Combination of all those things helped out. Geico actually looked better year over year as well because the company put through price increases as well, like the rest of the industry, and those started to catch up finally with the cost inflation that had worked its way into the auto replacement, auto parts, and everything else overall. So really, really, really good, strong year on the insurance side. And it was funny too, because we always sort of point to the diverse nature of the business and say that the non-insurance businesses, the railroad, the energy business usually kind of offset weaker years in the insurance business. Complete opposite last year. Mm-hmm. We had a great insurance year, but on the railroad business, weaker volumes. They were lapping price increases from 2022, so that impacted them as well. Slightly higher competition overall as well within, their part of the market. And then in the energy business was pretty stable, but they had to take accruals for California wildfires. So that, did a big hit to operating profits last year.
So I want to go back to insurance, and you were speaking about Geico and their solid performance. I mean, how sustainable are the improvements, especially in the light of the significant policy pricing increases and expense reductions?
It's going to be a little bit tougher. I mean, your policies in force were down about 10% year over year. So that basically they lost about 10% of their customer base. That's not too different from what we're seeing from a lot of the other auto insurers. It's just that historically what happens in these kind of environments is the insurers overshoot on the pricing side, and then everybody sort of tries to clamber back, to sort of recapture share they may have lost due to the price increases. So we'll have to see how that pans out over the next, several quarters, if not next several years. The good news for these guys is that, I think they went through a period, starting about 5-6 years ago, where they got more aggressive on underwriting. A lot of their peers had pulled back, had actually raised prices during that cycle, pre-COVID, and Berkshire went out there and got very aggressive, with Geico, and it hurt them because their loss ratios spiked dramatically. They were picking up a lot of poorer business than they probably should have been. And Todd Combs has been running that business since late 2019. At this point, the poor guy took over right when COVID hit. So it was, sort of the first 2-3 years he's been running the business has been completely abnormal. But I think now we're starting to get back to, a situation where pricing is starting to come down on, some of these, replacement parts, some of the replacement vehicles. The incidence of accidents have actually come down a little bit too, because again, the more cars we have on the road, usually accidents, increase. But we went through a weird phase post-COVID where a lot more reckless driving led to more accidents, but it's sort of diminishing a little bit here. So we're looking at probably better markets the next several years. But in Geico's case, they have to be careful because they always sort of run themselves as a low-cost provider. That always attracts sort of a less desirable customer base over time. Because people are looking for the lowest cost, and because Geico doesn't have a program in place to sort of gauge how drivers are like Progressive does, we think it makes it a little bit harder for them to pick sort of the best customers out there.
Well, let's look at the non-insurance operation, railway and energy. How does the performance of these segments impact the overall financial picture?
It does and doesn't. I think Buffett sort of looked at where those businesses were and what was going on, and he sort of put the brakes on some of the optimism we've been seeing out there with the markets the past couple months. But it is a concern, because you start looking at the other railroads and volumes have kind of fallen off some. Industrial has actually been surprisingly strong, but consumer volumes have pulled back. And the question is, are we still heading into sort of a slowdown as we move through the next 6 months to a year? And what sort of impact is that going to have on these businesses? The energy business is not quite as economically sensitive as the railroad or the manufacturing service retailing operations that Berkshire has. But there is some impact. And I think right now we're sort of in a phase where the expectation was the Fed was going to dramatically cut rates this year. And I think that everybody sort of pulled back from that some. The inflation numbers came out last month weren't that great. But, for the railroad, they had pricing inflation working on wages. Fuel costs were a little bit lower. But I think overall, the business just struggled a bit because, again, 2022 was a much better year. So 2024 should probably be a bit of a recovery. But at the same time, there are some headwinds out there. We're still not sure where the economy is going and whether or not that's going to impact volumes through the rest of the year.
Well, the report mentions a record $167.6 billion in cash and cash equivalents. So how does Berkshire plan to deploy this capital considering Warren Buffett's threshold of $150 billion and the current lack of viable investment opportunities?
Yeah, it's going to be hard for them to really work that down. I mean, it was interesting I remember at the 2017 meeting when he made that comment. I was like, wow, they're doing a decent job of balancing things. At that point, they were starting to pick up share repurchases. We had a period there for a number of years where they were buying back 8 to 10 billion or actually 25 billion in stock a year. So a fair amount of capital going to share repurchases. The past couple of years, it's actually pulled back more to 8 to 10 billion. And part of that's because the valuation of the Berkshire shares rose, pretty dramatically. I mean, Berkshire tends to outperform in poor markets. So it did really, really well in 2022 and did reasonably well last year. I mean, it wasn't going to beat the S&P 500, but it had a good year overall. So it makes it harder for Buffett to go out there and buy back stock. And when you don't have other real attractive investment ideas out there, and he even made the point during his annual letter, for Berkshire to move the needle, they have to find a sizable deal to do. And a lot of those options in the U.S. have been really fairly picked over. And it's not just buying it, because they have the capital to buy it. It's getting a decent enough return. And Buffett's always looking for sort of a 12% return on investment annually with whatever money he puts to work. Now, they've succeeded in a lot of ways. I mean, the railroad business that they bought more than a decade ago has been fantastic. Returns are definitely higher than that. The energy business, which they've acquired over a number of decades, also, has been a good generator for them on an adjusted basis. Because when you look at the utilities, you're trading returns for oligopolies in a lot of markets. But precision cast parts, which he also mentioned in the report this year, was a bit of a disappointment. They overpaid when they bought it. And then they've had a lot of issues with some of the businesses within there. So it's hard to find that really sort of truly good deal. I mean, Allegheny was a fantastic deal as far as we're concerned. I mean, it was $11.5 billion, but it melded very well with their existing insurance operations, gave them a lot of a boost basically on that business last year. But also, Allegheny was being run similar to sort of Berkshire in a lot of ways where they were taking a lot of excess capital and putting it in other businesses. So there's other businesses that they acquired there that had folded in their MSR segment. But again, when we look out there, it's just hard to find areas where, Buffett can really go out there and, get that big sort of eye-popping deal that's going to be very beneficial. And I think he said this probably 6-7 years ago that, but him and Munger benefited from the fact that when they started Berkshire, information was inefficient and there wasn't a whole lot of competition for the type of deals and things they were looking for. So they were able to have more of a freer hand going out there and finding more attractive ideas. What's happened in that, 40, 50, plus years is there's a lot more private capital out there right now chasing deals that Berkshire would be interested in and willing to overpay. And that's been sort of the secret to Buffett and Berkshire's success is they stay very, very disciplined and they look for the reasonable price point where they buy something. And information has become so much more available to everybody that there are no real secrets. And it's hard to find ideas that maybe nobody's paying attention to because the information is all readily available. So it's going to be very hard for this firm to sort of replicate what Buffett and Munger did, over the first, say, 50, 60 years of the firm. It's just really, not just for Berkshire, but it's really impossible for anybody to really kind of replicate that just because of those hurdles that are there now.
Well, Greg, looking ahead, what growth opportunities and, you kind of hit on some of the challenges do you foresee Berkshire having, especially in light of the company's unique decentralized structure?
Yeah, I still think there's growth within the insurance business. I mean, the price hardening that we saw, the past few years, is starting to wane a bit, but we're still looking at mid-single digit price increases this year. I mean, it's nothing relative to, say, the 20-30% price increase we saw, in the past, couple of years in different parts of the market, but it's still reasonable and it's not a price decline. So you're starting with that pricing there and you're growing your premiums, your underwriting. You're likely to still see mid to high single digit growth there. The railroad business, as I said, this year should probably be a slightly, better year in some respects because, 2023 was such a poor year. But, overall, we should see some benefit there. And then on the MSR segment, it's not a growth area. I mean, it's sort of a population growth plus a little kind of business. So you're looking at maybe 4 or 5% revenue growth at best, overall. And that's the thing. I mean, I think that's a mistake that some people make. You don't buy Berkshire because it's a growth company. You buy Berkshire because of the diversification within the businesses, because of the fact that they do have that cash pile, that they can become sort of the lender of last resort in down markets. In Berkshire historically, in our view, has been more of a defensive stock. It's one you really want to own if you think that the market's going to be more volatile and you want the stability that a company like this brings to play.
Well, thank you so much for joining me today, Greg.
Thanks for having me, Rosemary.